relative to 8% for the Russell. Our next guest may have been a little early, shifting from small to large caps, but better early than late. Rafael Resendes, a new face to Squawk on the Street, co-founder of the Applied Finance Group. Rafael, thanks for being with us.
Great to be here.
Now, one of the arguments you make for stocks right now is relative valuation relative to fixed income market.
Correct.
So that relative valuation has been deteriorating lately, has it not?
You know, on a PE basis, sometimes you can look at the PEs and you get the feeling that maybe PEs have been getting rich. One guest earlier, I think, was calling
I'm thinking this. I'm thinking that rates have been rising. So
Yep.
a month ago I was getting less than 4.5 on a 10-year.
Correct.
Now I'm getting 4 3/4.
Yep.
So the fixed income has become more attractive.
Fixed income is definitely, yields have gone up, but on an absolute basis, when you look at the market and you start to correct for things that filter into a traditional PE, where you get a PE of 16 on the market, which is a yield of around 6%. You know, if you look at the market today, 25% of the earnings in the S&P are reflected in R&D, which is expense. Never shows up in the E. When you start to correct for things such as this, you end up with kind of a modified or a correct earnings ratio in the neighborhood of 11, a PE of 11, which starts to give you an economic yield of around 9%. And you compare that to your alternatives around the world, right? You have junk bond spreads that have been crashed over the last few years. They've gone from 9 to 2. You have a world that's just swimming around in liquidity, and where do you put it? Iraq floated bonds yielding 9%. Iraq at 9% bonds. What are your alternatives, you know? With 9%.
Iraq at 9%? That should be 90%.
Isn't that amazing?
What's wrong with these high-yield investors?
Isn't that amazing? So you have the U.S. market where you can get a 9% long-term yield on an economic basis. It looks pretty good.
All right.
You just gave me my statistic of the day here, Rafael. All right, well, let's get to some stock names in the U.S. I know you've been skeptical. You stayed away from healthcare and tech last year. You were right. You still are skeptical, but you've got a couple names.
Correct.
Whip us through Force Labs and LabCorp of America, which is a name we've heard from a couple other people recently.
Okay, good. You know, we really like Forrest. They've done a nice job structuring their business around identifying promising stocks, working with smaller pharma companies that maybe don't have the resources to bring these drugs through the FDA approval process. They have 10 nice drugs in the pipeline, and we think where they're valued today, you're looking at a 20 to 25% upside from where they're trading now.
And LabCorp of America, as good as that?
LabCorp, you know, not quite as rich there, but again, a nice name. We're looking at 15 to 20% there in terms of a kind of a long to intermediate term target with them.
What's the matter, Mark?
A little skepticism there?
No.
Okay.
Thank you, Rafael. Rafael Resendes, thank you very much for coming in.
Thanks, Rafael. All right, up next, Dave's going to be along with the next edition of the Faber Report.